zero net supply. So many of them are derivatives in zero net supply and other assets in zero net supply, which basically means that they are not connected directly to consumption. So if you want to understand what is happening on the financial markets, it's probably not enough to think about those assets, which about the Lucas tree, right? The Lucas tree is the one which is directly connected to consumption. So that's José's interesting point. The other thing what I wanted to say is that there were some questions about the exogenous V0 in this model, the exogenous capital of arbitrageurs. So, so this is where this is the downside. Probably it has only downsides. The downside of the fact that I'm not doing a proper literature review, well, I'm not doing any literature review, is that I don't have references to the large literature or slow-moving capital. So slow-moving capital is exactly about this idea that that why not enough capital is going into these markets to make these problems to disappear. And for that, I refer you to Darrell's website, where you will find the starting points to think about that. Okay, good. So let's go on. So as I said, we wanna proceed this way. So we wanna take these lessons, what we learned about how arbitrageurs or just financial institutions in general are trading against local demand shocks, and considering their capitals and opportunities and constraints today and those in the future. And somehow we want to capture better that what is their effective risk aversion, which is coming out from this trade-off. We want to think about the determination of their capital, which should come from the returns, especially if there are no inflows and outflows into these models. And then we would try to think about asset pricing in general and see that whether this can lead to a new approach, or at least a different approach, somewhat different approach than before. Okay, so I will show you this in again. It's my model with Dimitri. So here is how it works. We still have a continuous time infinite horizon economy. Now there are no Poisson shocks. Everything will be slightly more standard. It's not as standard. I mean, when we go here, it will be even more standard. So if you want to go back to, but this is already will be slightly more standard. So it's continuous time infinite horizon economy, and there will be many assets. So we still want to now we want to price the cross section of all assets possibly. So we need many assets. And for now, we start with very simple assets. These will be short-lived contracts, which you can think of as insurance contracts, as we will see. So we will have n short-lived contracts, and each of them will pay out a random dividend only once. That's what it means that it's short-term. So it pays out one dividend tomorrow in the next instant, and then the asset disappears. And the question is that how much you want to pay for that one dividend. Okay, so we want to make this simple now because we want to think about pricing this risk of that dividend, and then we will go on and make it a little bit more stock-like. So this dividend is described, this n dividends, right? So we have n assets, are described with this vector of arithmetic Brownian motions. So you think of this as a vector. And this vector has a mean, which probably each value is different. And then it has some exposure to n Brownian motions. Okay? I hope this language makes some sense to you. I didn't. Okay, so those who, I don't know, it's continuous. I don't know how familiar you with this continuous time technique. So if you are more familiar with discrete times, basically the way you think about this is that this is a normal shock, and this is the mean of a normal shock, and this is the variance of a normal shock, and there is a normal distributed payoff. So that's the way you think about it. The important thing will be this variance covariance matrix of all of these shocks. Okay, so this sigma will be important. So you have these n assets, and we'll be interested in how to price this n short-lived assets, which basically means that you are pricing this single dividend payment in the next instant. Okay, so this is where we start. And it will have a price pi t. Okay, so that will be the price. This is the price what in this equilibrium somebody is willing to pay that asset which pays you one dividend in the next instant. We'll say it's zero net supply, so it's really like an insurance contract. And we'll introduce long-lived assets in a minute, but now it will be very useful to think about this like this. We'll have an exogenous riskless rate, so that's a major difference from consumption-based asset pricing, that there is a storage technology. So you have a fixed interest rate, you can keep your capital if you want for the future, or you can use it today. Okay, who trades? So instead of, you will see that there are similarities from that literature. So there will be hedgers, and these hedgers will be very similar to those noise traders in Schleifer and Vishny, or to those outside demand curves in my model. These hedgers, for simplicity, will live only for an instant, and they will have a mean variance utility function. And the important thing about them that they will be, their demand will be distorted. So this is kind of the same thing as what we see in the sentiment shocks. But we model with distortion. It really doesn't matter how we model it. The way we model it is that we give them, to keep them rational, we give them a non-tradable endowment. So basically, you can think of them as farmers who are producing corn. And one of these dividends are the corn produce in the summer when the harvest comes. And this U vector, which will be very important, this is the exposure of this representative farmer to each of these crops, right? So probably U is telling you that how much corn he produces, how much something else. So that will be his exposure to this risk. Yeah, I mean, I'm not very good in crops. So, but what is really, so all of this, the only reason why we kind of write this down to get this. Okay, so I will answer the question in a moment. But this is the only thing what we want to get out from hedgers. This is the demand curve. Okay, so the demand curve of hedgers, and that's for these assets, is a standard kind of CAPM type of part, which just says that whenever is cheaper an asset, this is the price, or whenever its risk is lower, they want more. So that's kind of the standard thing. And then there is the U vector, which this is a vector, this is a vector, which distorts their demand from this standard CAPM demand. Okay, and this vector is a constant. So basically, what it's capturing is, and this is what our intermediaries will trade against. So you can kind of see that all of this is related to the previous class. Just a moment. And this can be negative or positive. Okay, so this kind of distorts their demand to some way. And the way you understand it is what I said at the beginning. So this is kind of a reduced form description of an average persistent demand imbalance in one particular market, which come from regulation, benchmarks, any other constraints, or hypes, or fads, or anything like that. Whenever it's positive, whenever any component is positive, it means that hedgers distort their positions downwards. So basically, they are selling that asset. And whenever it's negative, they are buying that asset. Okay, so more than they should. Or price sensitive risk, whatever you want. Yes. Price sensitive noise traders. That's what you said. Yeah. I mean, that's if you want, you can think of them. This is constant. I mean, that's something what you have to keep in mind. So it's a parameter. Yeah. So it's not random. So there is no noise. No noise as such. There are distortions. Okay. And for that particular moment, we think of this as a constant distortion. So there's a tension in the asset market. And this vector generally, some of these vectors, some elements are probably zero, right? If that element is zero, in that particular asset, there is no distortion, there is no tension. You are not trading against anything. Yes. For today, yes. I mean, we are working on the extension, but I won't talk about it. So here it's constant. Okay, so that's starting point. Now, the way you want to think about this is that in aggregate, probably it's unobservable. So empirically, you can kind of trace out some of the parts of these distortions. You can kind of say that, oh, S&P 500 index introduces a distortion through index traders, and then some of these U's are positive. But you have to kind of, for this model, you have to look the whole market outside of these intermediaries, outside of these frequent smart money traders. So probably just by looking at it, we don't know where these U's are. Okay, they are somewhere. And that will be an issue. So, and then the other part of the model, so this is half of the model, the hedgers. And then the main guys will be these arbitragers. We call them arbitragers because of the continuity of the previous part of the class. But really, they are just traders. Dealers, brokers, hedge funds, trading desks, they are the smart money. Okay? There will be nothing safe in what they are doing. They will have a standard CRRA utility function. Nothing fancy here. And with some gamma parameter, I will play a little bit with this gamma parameter. And basically, because of distortions, basically their game is to trade against these distortions, or you can say that they are providing insurance against these endowment shocks. So whenever this guy really need a contract which pays a high D whenever his D is low. So for example, if U is positive, one element of U is positive, it means that he wants to internally, he's suffering from the high D shocks. So he wants to have a short position on an asset which pays him minus D whenever the D is large, right? So that's kind of the idea. So these guys are, you can think of them for now as insurance providers, okay? And that's the model, okay? That's what we want to solve. So it's in some sense, this is the model. You have these guys, and you have these guys, and you have the N assets, and you want to work out what will be the price and what will be the dynamics. Now, these guys live forever. So their wealth will be quite important. It turns, each of them are small. Their aggregate wealth happens to be the state variable in this model. So the dynamics of their wealth is just the usual thing what you would expect. This is their position, right? This is a vector of position in each of these assets. If it's positive, then they are gaining whenever the dividend is large and the price is small. They might consume, and they earn something on the storage technology. So solving this is relatively standard. So basically, you are conjecturing this value function, which happens to be the right value function. And I guess the only thing what I want to emphasize is that so this is your individual wealth. So this is coming from the CRRA part. And then this thing here will be an endogenous function, which is the marginal utility of wealth. And it depends on the aggregate wealth. That will be the state variable. So that you have to show. So that's kind of part of the solution. And this marginal utility of how useful to have a unit of wealth at a given point will be important. So here is what you get for their demand. Okay, so this is arbitragers demand. So we had hedgers demand. Now we need arbitragers demand, and it looks curiously similar to the previous function. These guys are still buying something if it's cheap, and if it's not very risky. But now instead of this, so this was a constant risk aversion, which we just assumed for the hedgers. Instead of this, they have this A function here, okay? And that's what we will call effective risk aversion, and this is something which you have to solve for, okay? So this is something which will tell you that given the risk, given the mean dividend, and given the price of this insurance contract, how much you want to buy or sell of this. And it turns out that in this model it has a very, okay, shouldn't say very simple again. So it has this particular structure. It has this static absolute risk aversion part, and it has this intertemporal hedging part. Okay. So what it means is that this is something which you saw in microeconomics. So basically, I'm a constant relative risk aversion guy with a given risk aversion. Then my absolute risk aversion is just gamma over my wealth. Okay. So basically, in general, I will be less risk averse, so to speak, if I'm less risk averse, and if I'm very rich. Okay. So that makes sense. Now, a lot of action is coming actually from here, and that's endogenous, right? So basically, what it captures, intertemporal hedging, captures the idea that I want to look for the future opportunities, right? So if I think that in the future there will be really good opportunities out there, then probably today I'm not very keen to invest. I want to save something for that future opportunity. That's what we call intertemporal hedging, and the effective risk aversion will be the sum of these two. So let me show you how it looks like for different risk aversions. So two interesting cases. So in the model, we solve for everything, for any gamma. But two interesting cases are kind of like the extremes. So one of them is log preferences. So if gamma is 1, then this thing here is 1. And it turns out, I don't know whether you know this or not, logarithmic guys are basically myopic. So they don't have intertemporal hedging demand. So this thing actually disappears. So then this absolute risk aversion is just 1 over W, and that's it. Yes?
The derivative of your value function with respect to own wealth, but then you're taking the second derivative as a total derivative with respect to both own wealth and aggregate wealth, and that's how you get the return. And so what is the argument that the aggregate wealth part is associated with the integral part, whereas the static part is associated with the own wealth?
So the way I would think about this is that given that this WT will be the state variable, it captures, basically what it does capture is prices, right? So it's basically it captures what will be the return in a given point. So what prices are depending on is aggregate wealth and not individual wealth. So I would say that the reason why this comes in, this aggregate wealth here, and this point by intertemporal hedging is dependent on aggregate wealth, because that's what determines prices. If that answers your question. This should be actually your own wealth. It's just in the representative, once you aggregate off, it happens to be the same as aggregate wealth. Very good. So in logarithmic preferences, that's very simple. And the other interesting case, which didn't get into the paper because of the referees, but I was very sorry for that, is that if you go to the risk-neutral limit, it happens to be your effective risk aversion becomes something very explicit. Okay? So in the risk-neutral limit, this thing disappears, and only this stays. So basically, the only thing what you can recover is the effective risk aversion due to the fact that you care about future opportunities. And it turns out that in this particular case, it's the cotangent of wealth. And so effective risk aversion is the cotangent of wealth. It's one of the very, very few models where cotangent plays a role. It's not the only one, as I learned, but it's one of them. This is how it looks like. So if you kind of don't remember how cotangent looks like, so basically this is the risk-neutral effective risk aversion as a function of aggregate wealth. And this is the 1 over W. Okay, so this is the case when in the log case. And the reason why you have this line here, because in this risk-neutral limit, it turns out that instead of consuming in every instant, you are not consuming until a point, until you are rich enough, and then you consume everything. So basically, in that case, aggregate wealth never goes above a certain level, but that's a detail we are not super interested in today. But what you kind of see is that although they are coming from absolutely different sources, they look kind of similar, right? So whenever these intermediaries are poor, their effective risk aversion will jump up for different reasons. And whenever they are rich, their effective risk aversion is very small. They are getting close to risk neutral. Yes?
So, there's this classic inability to disentangle temporal substitution and risk aversion
Uh-huh.
in this kind of
Uh-huh.
reference model. And I'm wondering, since your asset markets are just for short-lived assets,
Uh-huh.
that this, what you're calling the second term risk aversion is not, is really more related, perhaps, to intertemporal substitution effects associated with your changing wealth. Is that possible? Or
Well, you still have better opportunities. So that price of that very short-lived assets,
right, but you have full hedging coming from the asset market of all wealth stocks, right?
yes.
So you don't really need additional.
Oh, no, you cannot hedge your aggregate wealth shocks. You want,
I thought the asset prices. Oh, I see. That's right.
you are
Hedging
the dividend.
for one period.
Exactly.
So you have motives to both account for intertemporal substitution effects and risk aversion effects.
Yes. So you,
What you told me about my paper, I have went and investigated. This is related to the John Campbell 1993 paper, which is subsequently adopted for something. And in fact, the IES is thinking about relating to the communicated at a time for preferences, including the gamma parameters, bigger or smaller ones. It's about myopic portfolio choice versus non-myopic portfolio choice. The IES is not involved.
okay.
So I know that about Peter's paper. Peter told me this was his paper after I tried to replicate something I had not compare Peter's paper. I went and investigated. The one question I have is no answer.
No, it's not the only one. But yeah, so anything related to Epstein's preferences and the difference between gamma and whatever sigma, what you use for the, I refer you to Ben. Okay, so okay, so very good. So we have effective risk aversion, and it turns out that if you work out the equilibriums, it makes kind of sense. So basically, the way arbitrageurs are taking position is that they share the effective risk. What you can share in this economy is this U vector. It's proportional to this U vector, right? So U vector tells you that how much exposure these hedgers want to hedge. So they will take a position which is proportional to this U vector, and the size of the position depends on their relative risk aversion compared to the other guys, right? So they share their risk in proportion to their risk aversion. The risk aversion of the hedgers is just alpha. The risk aversion of these arbitrageurs is this effective risk aversion. And then you get a pricing formula where you have the expected value of the asset and the premium. And this premium is again, this is a scalar, this is a vector. So basically, we saw that when the aggregate wealth is very small, this thing goes to infinity. If it goes to infinity, you have alpha times sigma u here, which is basically the cap and premium. And when aggregate wealth is very large, you get 0 here, and there is no premium at all. So that makes a lot of sense. So depending on how much risk these arbitrageurs are willing to take, the premium is going up and down. Okay? And their position is scaled up and down, but always proportional to u, because this is what they are trading against, right? So that's kind of like where this limits to arbitrage logic comes in, that this u vector, they are trading against this u vector, whether it's positive or negative. Now, one thing what you can do, which I don't want to spend too much time, is to actually derive what is the distribution of how wealth develops in this. So now wealth is actually endogenous. We don't have V0. It will be endogenous. It depends on how much money these guys make. There is no inflows and outflows. So their capital, this aggregate wealth, this W, depends on how much money they make. And it turns out that in general, there is this ergodic stationary distribution. So it's not a fixed point. We are never converging to one particular steady equilibrium. Instead, whenever the aggregate wealth is small, returns will be large, and these guys are getting richer. Whenever aggregate wealth is large, returns will be small, and they are getting poorer because they are consuming. So under different parameters, you can derive what will be the shape of this ergodic distribution. Sometimes it's like decreasing, so most of the time you spend, it's a PDF. What you see here is a PDF. So most of the time, sometimes for some parameters, you spend a lot of time in this small capital region. For other parameters, it can be bimodal. It might be that you have spent a lot of time here and a lot of time here and nothing in between. So so the only thing, I think it's very interesting, but I don't want to talk about it now. The only thing what you should take away is that there is an ergodic distribution. So basically, there is trade in this model. It's not that we are converging to a fixed price. Even if you don't do anything with this economy, you are going to crisis times and rich times because the wealth of these arbitrageurs are fluctuating with the shocks. So asset pricing. Okay, so I promise you some asset pricing. Yes?
Why aren't the behavior of the arbitrageurs just correlated with standard?
Okay, so there's a representative arbitrageur. They can do exactly the same thing.
And then when you say that there is density, you mean that
So basically what I said is that the wealth, suppose that everybody has the same wealth. Actually, they do. So they have the same wealth, but this wealth is changing over time.
I see. This is over time.
Exactly.
Okay.
Sorry. So if it was not, yeah, it's not a cross, very good. It's not a cross-sectional distribution. It's an ergodic distribution of the state. So basically, it's an aggregate state, and sometimes we are in a period with a lot of capital, when everybody has a lot of capital. These are good times. This is when things are smooth. Basically, there's a lot of insurance provided to these hedgers. The effect of these U's are very small. And then there are bad times when we are here, where very little capital is around, and all these premia are very large. We have a large risk premium on everything. We want to do asset pricing, and for asset pricing, we need long-lived assets. Okay, so the reason for that, because with short-lived assets, the price of an asset is a constant in every given point. So you cannot really think about returns which are coming from changes in prices, right? So with long-lived assets, when you buy a stock, you want to think about what happens with that stock price tomorrow. If you buy this short-lived insurance, there is no price. You cannot sell that asset anymore because it ceased to exist. So what we do next is to change our short-lived assets to long-lived assets. So we can think about asset prices a little bit more. So basically, we'll have this price as t and a standard return. And basically, this asset will give you this dividend all the time. So instead of disappearing, this asset is not disappearing and give you this dividend all the time forever. And the question is how you price this asset, which gives you this random dividend all the time. You still have n assets because each of them are exposed to a different dividend. Okay? Now, why we did this in two steps? Because it turns out that it's still a complete market, right? So we had a complete market before. We have a complete market now. So basically, the risk what you are buying will not change. So these are equivalent risk-sharing opportunities. So everything what I told you about the wealth distribution and then how much risk you want to buy or sell is still the same. The only thing what has changed is the price of these assets. Because these are different assets, so they have to have a different price. Okay? And the reason, the reason why we are doing that, because we want to arrive to something similar to what we had at the beginning, an asset pricing formula, where we have some covariances and you pay more or less for different covariances. Okay, so so here it's basically, if you start to think about it, it's basically one step. So which asset should have high price and which asset should have low price in this economy? That's basically the question. And the arbitrageurs will price these assets, and the main worry of these arbitrageurs is that whether a given asset will pay up when they are rich, or whether it will pay up when they are poor, or whether it will pay up when their effective risk aversion is large, or whether it will pay up when their effective risk aversion is small. So, so to think about this, I mean, let's think the following way. So arbitrageurs are still holding cash flows in proportional to you. This is the risk what they are sharing. So if the dividend shock hits, when there is a shock, their wealth drops proportionally to this U. So whenever a dividend which corresponding to an asset which these hedgers want to hedge, so they want to sell, these arbitrageurs will take that trade because the price will adjust in a way that they take that trade. So whenever that dividend actually hits, they are losing money. Okay? So whenever this shock hits, their wealth drops proportional to you. So what they require high compensation for, just by standard asset pricing argument, is for holding assets with low returns when a high U asset has low returns. So basically, what will come out of this is that expected return will vary with the covariance with U. So you want to hold all the assets. You want high returns if you get paid when your portfolio has low returns, right? And your portfolio is proportional to U. So the covariance with this U portfolio will give you the cross-section of asset prices. Okay, so probably that was a little bit too fast. Once more. So basically, it's actually very, I mean, I don't know whether it's trivial or super complicated. So basically the idea is this. We just assume that the main reason why these arbitrageurs are trading, because they are trading against this U distortion. Because they are trading against this U distortion, their portfolio will be proportional to that U. And because their portfolio is proportional to that U, whenever a high U asset pays up, they are, that's a good state for them, right? So any asset which covers with this U will have a low return. Okay? So very similar logic than standard asset pricing tells you that the cross-section of asset prices will be related to the sigma U term. Okay? Yes.
So hence the risky assets.
Yes.
We have two key subscripts. One is for the start of payout, and one is for the price
No.
time.
They pay every point.
Forever.
Yes. Yes. So risky assets are a dividend flow. Every point they give you a dividend.
So when you say what matters is that when they pay out.
Oh yeah, sorry. So the so the way I meant is that when they pay out more, right? So sometimes they pay out more, sometimes they pay out less, depending on the dividend. And the question is that do they pay more dividend when you are poorer, or do they pay more dividend when you are richer?
So they have some covariance with the dividend.
By construction, right? So basically the dividend. So the dividend is. So the dividend is every dividend has a covariance with these Brownian shocks. So there's a covariance between all the assets, right? This is this sigma. And then you are holding them in proportion to U because that's what you are trading against too. So you need, so you will lose money whenever a high US, a very low negative U asset pays up. So when you lose, so you want less compensation for assets which cover with this U because that's what you are getting money when you need it. That's kind of the idea. It's, in some sense, it's very simple. It's just a lot of notation, and then it becomes very complicated. So this is the argument, but it's not only that. So if you look at this expected return, So this is the difference. So two assets have different returns only because of that reason. This is a vector, and this is a scalar. So how big is that return, how big is that premium, will depend on the wealth of these arbitrageurs. So as their wealth is changing, the prices will change, returns will change, and they will scale kind of up and down. This premia will scale up and down because of this change. Yes? The arbitrageurs. Arbitrageurs are, well, depends what U is. So they're holding, their position is they're trading against the hedgers. So in some sense, because U is fixed in the equilibrium, they will have the same proportion of assets all the time. So it's just,
they're holding the same index.
Yeah, you can call it like that. Yes, this index might not exist. I mean, we don't know that index, right? That's very important. It would be, if we knew that index, we would be done. But we don't, probably because this, in a more sophisticated model, this U is actually changing. So it's not that easy to catch. I, as the modeler, know. They, as the traders, don't. The arbitrageurs don't have to, right? Because they are basically, their demand is not, they are trading with the prices, right? So the price, they're buying whatever is cheap. They're selling whatever is expensive. They don't have to, I mean, if they understand the model, they know that this is their portfolio, so they just look at their portfolio and then they realize what is the index. But they don't have to know it to trade. Okay. Yeah.
What was the role of the farmer, the one who holding down the risk endowment in this model? Because it looks like, and the only thing that plays the role is this view.
Exactly.
Irrational.
Exactly. So they're only.
Where did you need it?
Yeah, you need a downward sloping demand curve. So you needed that.
Just to generate the.
Yes.
Okay.
So if you want to assume that, that's fine with me.
Okay.
Exactly.
Yeah, sure.
So if you want to assume a downward sloping demand curve with some distortions, that's good enough. So that's.
There's no risk sharing between the
Oh, there is. I mean, this is risk sharing. I mean, that's where this whole thing is coming from. The reason why. So if this is an endowment shock, if it's coming from the, if these are really hedgers, if we microfund them that way, then this becomes a risk sharing contract.
Yeah, okay. But suppose there was no U, then the arbitrator doesn't have a
Exactly. 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 Yes. How far?
Yeah.
Well, exactly that far. So I will connect this to the standard consumption-based asset pricing model in a minute. If that's so when I go to here and Krishnamurti. So in this, so intuitively what is happening. So I don't know whether you are asking technically or intuitively. So intuitively, what is happening is that the way we think about these guys is that they are the active, they are the kind of the smart active guys. Exactly. So basically, all the variation in prices is coming from them, because these guys are constant, right? So the way probably you want to think about this is that this demand is probably coming from production, right? Something which is fairly constant, for a while it's constant, and then there are these arbitrageurs who are trading like crazy to make money. And their wealth is, these guys don't have wealth effects at this point. So one way to think about this is that we are talking about different frequencies. There is a business cycle fluctuation, which we are not modeling here, which would kind of push this around. And then there is the kind of financial liquidity fluctuation, which is this aggregate wealth, which is actually affecting most of the variation in asset prices. We can return to this. Okay, so here comes the reason why I'm showing this to you. So it's an asset pricing model, okay? So whatever gives you expected returns, it gives you cross-section of expected returns and the time variance in expected returns. The question is how useful it is, okay? So the problem is that it has a bunch of objects which I claim is hard to observe. So it has this U deviations, which we don't really know what they are, right? And it has this effective risk aversion, which we can calculate under certain assumptions. But in general, what exactly the constraints and opportunities of these arbitrageurs are not that easy to capture empirically. So the question what to do with that, whether it's an empty theory or whether it gives you something which is probably testable. So it turns out that, and this is largely not our, many of these inventions are not coming from us. It turns out that by now we know at least 3 methods to do something empirically with this kind of theory. Okay? So one of them, so let me talk about these 3 methods. So one of them, what we do in the paper. So in the published version, we are connecting this to the liquidity factor literature, which is again something which I didn't talk about, but it's kind of interesting. So the liquidity factor literature, it's an empirical literature. Well, it's not only an empirical literature, but a part of it is an empirical literature, which does the following, which observes the following, that you can measure illiquidity of each asset individually as some kind of response of to price pressure. So the question is that if you measure a shock to some kind of selling pressure to a given asset, how much the price adjusts. That will be the illiquidity of this asset, and there are multiple ways to try to do this empirically. So you have an illiquidity of an asset, and it turns out that if you take many assets together, this illiquidity moves together. So sometimes all assets are becoming more illiquid, and sometimes all assets are becoming less liquid. So that's what we call commonality of liquidity. So it turns out that if you turn to our model and construct a measure of individual illiquidity, and then define a liquidity beta by the covariance of the innovations in this aggregate liquidity measure, this commonality component, and the individual returns, then it turns out that this beta will be proportional to sigma u. So you're kind of measuring this sigma u with that variation. And then you have a liquidity factor pricing model, which happens to kind of work empirically. Okay? There's a lot of jump here, and I don't want to kind of give you the details. I just want to give you the idea of once you see these 3 methods next to each other, you probably will have a feeling of where to look for empirical counterparts. So basically, the issue is that the idea is that how to capture empirically this sigma u, and then how to capture with that sigma u, how to capture the effective risk aversion. And one way is to individually measure how prices respond to a given small shock, then take the average to have a common liquidity measure. And because we know that whenever these guys are more risk averse, prices will respond more because they are less keen to absorb these shocks. We will have a function of effective risk aversion. And once we have an effective risk aversion function, if we take the covariance of the innovations of that effective risk aversion function with returns, we get a beta which happens to price assets. Okay? So method 1. Method 2, and I will talk a little bit more about this, that gains a lot of popularity nowadays, is directly somehow measure the effective risk aversion of intermediaries. And I will show you in a minute that what kind of work has been done on that front. But that would be another idea. So to somehow directly capture what makes effective risk aversion change. And then in our model, you can show that once you have a function like that, you take the covariance of the innovations of that function with returns, you get a beta which price assets. Okay? And then the third measure is what Ben is doing, is to which kind of feeds back to our original or of our morning slides, is that suppose that you can actually identify 2 assets which has near the same distribution of cash flows, like arbitrage opportunities. So if you take something of, so in our model, suppose that there are 2 assets, they have the same mean, and they have the same variance, and the correlation between this dividend shock is almost the same, it's close to 1, then the difference between the prices, just by the equations which I showed you, is this. So it will be, oh, and they have different U's. So whenever they have different U's, there will be a price gap between these two assets. And this price gap, and whenever, as long as the rho is not exactly 1, and that price gap will fluctuate with the effective risk aversion of the arbitrageurs, right? So that kind of corresponds to the original arbitrage which I showed you. So we saw that these arbitrage gaps are larger than the capital of arbitrageurs is smaller, and this is exactly what is happening here. So these arbitrage gaps will scale up and down with the wealth of arbitrageurs. So that difference can work as a proxy for the effective risk aversion of these arbitrageurs. And then you can do exactly the same as you did before, measure the beta with respect to the variation of this price gap, and have a pricing model. Okay? I kind of feel that I'm losing you. So let me summarize what is happening here. Okay, so before I'm going on. So basically, what we say is that instead of working with consumption, instead of trying to figure out how asset prices should vary in the cross-section because they're covariance with consumption, let's work with the following hypothesis. There are these representative smart money, and they are extremely important for asset prices. That's kind of the main idea, is that most of the variation is actually coming from them. It's not coming from the variation in consumption. It's coming from the fact that sometimes they are richer, sometimes they are poorer, sometimes they are more constrained, sometimes they are less constrained. Now, to make this idea work, let's just invent a vector of mispricing, so to speak. Okay, so this is U, right? So U is basically saying that there is some mispricing out there, fundamental mispricing, which is coming from, probably they are small, probably they are large, probably sometimes they are small, sometimes they are large. And what these arbitrageurs are doing are trading against that mispricing. Okay? If you have these two ingredients, basically what we show, then you can derive an asset pricing model out of that just by very logical steps. And then there are a bunch of things which empirical people do to explain asset prices, and it seems that some of them correspond exactly to that model. Okay? Yes? Yeah.
So they were supposed to trade 51, 60, 40.
Yeah.
And they were trading anywhere above that, sometimes above that, sometimes
Yeah.
below that. How does this theory, what does it say about that phenomenon, the temporal evolution of the arbitrage gap? So it's vanishing and opening up.
Yeah. So basically, it should, according to the theory, it should open up and, well, as long as we think that the two steps, right? You have to say something about why it exists at the first place, and then, no, it's not. That's probably an exaggeration. So there are a lot of papers about it, right? So you know the way you think about. So one way to think about this is that the reason why this mispricing exists is because there is because Royal Dutch is traded in Amsterdam and Shell is traded in London. So you cannot literally take a boat and buy a Shell stock and sell it in Amsterdam. Instead, the only thing what you can do is to do convergence trade. And possibly, there are some local demand shocks to this asset. So that's the starting point, right? So the reason why this, so that's, I think, you know, that's the example which I used originally for my job market paper. So basically, the idea is that there is a local demand shock, and that's why for some time, fundamentally, these prices are differing. But the interesting part is not that. This is just by assumption. The interesting part is that once arbitrageurs are standing in, they will change the nature of these shocks. according to this theory, basically this gap will be, if under the assumption that the underlying tension is the same, which probably not true, but suppose that it's the same.
Underlying what?
Underlying tension. So the local demand shocks would be the same in the underlying market, which probably they are not. Probably they are fluctuating also, but let's just make the assumption. Then this gap will be exactly proportional to the wealth of those arbitrageurs who are doing that trade. So even if the underlying demand is the same, it will fluctuate. This gap will fluctuate because when effective risk aversion is going up, when their money is more useful somewhere else, or they want to save it.
So what can they do? You don't see the wealth. You don't see the arbitrage's wealth. So what can
This is the arbitrage's wealth.
what?
Oh, we don't see. Exactly.
It is on the board.
Exactly. That's why I showed, exactly, it's very good. So you are exactly in the right track, it's just I'm doing a little bit too fast. So that's why we have these methods. So there are 3 methods to back it. Right? This is the 3 methods which I'm proposing. And some of them, it's not my proposal, but in the literature, the 3 methods were proposed, in my understanding. One of them which we proposed is that it turns out that if you just do the liquidity exercise, what you will get, the aggregate liquidity factor, which you can measure, will be proportional to this W. And then the covariance of that liquidity, innovations of liquidity factor returns will be proportional to sigma u. So the 2 things which you cannot observe, now you have a proxy for. That's method 1. Method 2, and that's what I will show you in a minute, he and Krishnamurti, and later here, they say that you can measure this from the balance sheet of certain intermediaries. And I will go there in a minute. And method 3, you just take the arbitrage opportunity itself, and as long as you are confident that this arbitrage opportunity has this structure that these financial guys who we think are very important are trading exactly to one direction all the time, then the volatility of this gap will capture the variation in this effective risk aversion and this wealth.
Even this idea that liquidity is local is a problem, because you think about people like Goldman Sachs and hedge funds, they're guessing local money around with the capital from one side to the other. So do those arbitrageurs.
Yeah, arbitrageurs are moving. The local guys are not moving. So we are kind of, so the critical distinction here, which you might or might not like, is that there are some local guys and there are some arbitrageurs. And the local guys have some demand, local demand in those markets, and the arbitrageurs are trading against that local demand. So this is our construction, right? So this is kind of like ongoing construction in all of this. Yeah.
At least in your model, and I think this is true of all these models, if you found the Goldman Sachs consumption,
Yeah.
that would price the asset.
Yeah.
Do you think that that's a productive avenue of research going forward, or do you think that
So exactly. So
try to connect these things?
yeah. I mean, this is so that's a question whether you are So I think it's a big challenge for the empirical literature is what proxy to find for this effective risk aversion. The way I see many of these experiments is just different. So some people argue that when you are finding a proxy, that's a test of what theory is good. I don't think that we can say that. So the way I see it is that this effective risk aversion is there. It will depend on, in reality, it will depend on constraints, opportunities, incentives, regulation, whatever. And we should not expect that the proxy what we are finding is super closely related to the theory, because then we are going back to the same, probably I shouldn't say mistake, but the same problem of what we see in consumption-based asset pricing is that you are really keen to matching one-to-one, and then you are ending up with very sophisticated, very complex models, which are very hard to interpret. So, so my expectation is that there will be different proxies and some of them probably will start from the idea of, so I see now these three ideas to work with. Before last week, I saw only two, right? So before you showed me your model, I didn't know that that could work. So in principle, I knew that it probably could work, but and Goldman Sachs consumption could work in principle, but whether there is a possible proxy for that, I have no idea. It's really, for me, it's a measurement question. It's a very interesting question, but I don't know the answer. Yes? Yes. Yes. Yes.
And that seems like a relatively modern phenomenon in the
Yes.
market. So we can think of this as having changed over time.
Yes.
Does your model have, are there like historical progressions along that? Thinking about how
It's an interesting question. So some there were, for example, there is one of my colleagues worked on that whether how pricing changes after the discovery of anomalies, right? So this would be kind of one approach that there is an anomaly and now it's public and then more people trade, and whether we see that according to our model whether the return and risk is changing accordingly. So in this very abstract form, you can limit the market the way you want, right? So you can say that this is only two assets and I'm just pricing those two assets, or it's the whole economy and then I'm pricing many assets. But it's an interesting question. We didn't try that. Okay, so before I'm running out of time, so let me talk about other, let me emphasize again. I'm showing you a very distorted view of the literature, okay? I cannot emphasize it more. For example, this paper which I show you now in probably much shorter time is much more influential than our paper. So you have to take all of my biases into account when you interpret it. Okay, so it's actually much earlier. So this is a very early work which basically asks the question, exactly that question, that how should we think about the effective risk aversion of arbitrageurs measuring through the balance sheet of intermediaries. And that turned out to be a fruitful way, even if the model itself is again quite abstract, so you don't want to probably literally translate one-to-one what is happening. But I show you how they did it. Okay, so basically what I show you in the last half an hour is some basic ideas that what was this probably one of the first usable intermediary asset pricing model theory, and then how Jigo translated this to measurement and empirical implementation. Again, he was not the only one. There are 1,000 more papers, and you have to do your own research if you want to know the balanced picture. Okay, so this paper is actually much closer to the consumption-based asset pricing framework in many respects. It kind of tries to do a smaller step. It's also much earlier, so they had a harder time to sell it to consumption-based asset pricing fans. So it's more like a continuous time consumption-based asset pricing model, and with where is it? I had a, yeah, exactly. So it has a representative investor, and this representative investor has to hold all risky assets. So you don't have this kind of trading against attention type of idea. It's a standard one guy, the specialist hold all risky assets. It also has risk-free asset in zero net supply as opposed to in our model. So it's not an exogenous interest rate. It's an endogenous interest rate, but you cannot store money from one period to another. And just as in consumption-based asset pricing, risk premium has to adjust to make these representative investors, which we call specialists, to be happy to hold all the assets in the economy. However, this goes back to Schleifer and Vishny in the following sense, that it gives you some idea that when they these specialists are getting more money and less money from households. Okay, so there will be some endogenous and actually very properly done contracting, which tells you that at least compared to that literature, tells you that how much money they should get when. So let me. So probably it's not clear. So this is the structure. So we have households, and the main assumption is that these households, that's the difference between a standard asset pricing, consumption-based asset pricing model. These households cannot buy risky assets directly. The only way they can have risky assets is that they invest with specialists. So think of them as hedge funds, and then basically households can give them money to invest, and then they will be equity partners in this hedge fund. And then riskless assets are fine, so you can still borrow and save this riskless asset, which is a zero net supply. So basically, the main idea is that at the end, it will be a closed model, so it will be a general equilibrium model. So basically, at the end of the day, all the savings has to go into the risky asset because the riskless asset is in zero net supply. So the only question is that whether the savings of household is going to risky assets through directly, in a risky way, I should say. So whether it goes in a way that they invest as equity in these funds and take and suffer the risk of this risky asset, or it goes indirectly by lending money to the specialists. And there will be an optimal contracting problem between these two guys. Okay? So that's debt financing. Oh, I see, like a risky bond. It's not here. No. I mean, I guess you can say probably that this will capture partly that one too, right? So basically, this is an equity a part which they can lose. So it's a risky way to financing them, but it might be. Probably you have some ideas as why this is very different. Yeah. So, listen for new ideas. So this is not done here. Probably you know papers where it's done, but it's not done here. Okay. So, but you can kind of see what will be the main thing here is that the leverage of these guys will change, right? Because sometimes they get the money as equity, and sometimes they get it as debt. So, and that will be the reason why it turns out that the leverage will say something about the state of the economy and the effective risk aversion. So let me show you how it.
In the model, the debt to the specialist is mispriced.
That to the model is specialist.
It was risk-free, the next is risky.
It is risk-free. They're always getting back what they.
Who?
Everybody gets, like through this market, you get a riskless return, and you invest in a riskless return, and you get back a riskless return. There's no default, right? They never default. It's continuous time, Brownian motion, so we don't have any problem of creating a model with no default. No jumps. Yeah, so nothing is mispriced. Everybody is rational. Okay, so what is the contracting problem? The contracting problem is a moral hazard problem. So basically, these guys have the choice of providing, so whenever they invest, and whenever the households give them money, they have the choice to give them back the return on the risky asset, what they want, or they have the choice of shirking, which basically means that the return on that investment will be smaller than what they would get directly in the risky asset market, and the specialists are getting some private benefit. Okay, so standard moral hazard problem, and the way you solve that is what we call skin in the game constraint. So basically the way you solve that is that these households will be willing to give money to the specialist only as long they know that they have enough own wealth in the fund. That's what we call skin in the game. So there will be a constraint that say there will be this M1. This depends on the parameters of the model. And the households are willing to give money to the, if M is 1, they are willing to give money to the specialist only 1-to-1 with their own funds. So as long as they have 80 capital, the households are willing to give 80, but not more. Yes?
How would the household know how much money the specialist is putting in?
Yes.
No, how do they?
Or how do they know that? Perhaps, but I'm making that up. This capital, so the state variable will be the aggregate capital of the arbitrage of this specialist. So looking at the prices, you can figure it out. So the equity premium will be proportional, but I'm making that up. So
To be part of the contract, I mean, typically when you invest in hedge fund, you know how many departments.
better answer. Very good.
So you know that. You know what's the share of the hedge fund that is held by department. Nobody's going to invest in a hedge fund that is 100% limited partners. They have to have a stake. And make money, you have to have a
So these are households.
yeah. Those are very
Yeah.
they're sophisticated households.
Yeah. They are very rational. They are.
Then why can't they invest in risky assets correctly?
Well, they don't have the time. You know, I mean, some of us are not investing directly in risky assets. I don't want to, and probably not all of them are. All of us are very stupid. So, yeah. No. But so that's an assumption in this. I mean, this is a strong assumption, but it's not that irrealistic. I mean, a large part of households are not investing directly. Almost no one invests directly in the risky assets. Okay, so what is happening? So once you derive this M, so that will be like an equilibrium object, which will be, let's say it's 1. When there's a lot of good shocks to the economy, the wealth of intermediaries go large enough that this constraint is not binding anymore. So let's say that the intermediary wealth is 100, and let's say that household's wealth is 80, then they are happy to give all the 80 to the specialist. So altogether, 180 will be invested in the risky asset. So the price of the risky asset will be 180. However, when these guys are starting to lose money because there is a lot of negative shocks in the dividend process, they will get only 50 wealth. Then the price of the risky asset is still 130 because at the end all the money has to end up there. But now only 50 can go through as equity. The rest, the households will lend to the specialist through the riskless contracts. So basically, the idea is that now funds specialists are poor. They have very little money. So the household comes and thinks that, okay, should I really give all my money to them as an equity? No, because they will just shirk. They don't have enough skin in the game. So I just give less to them. But then I'm sitting a lot of money which I have to do something with because I don't want to eat it. I want to save it. So there will be a lot of demand for riskless assets, which is good because that will make the interest rate collapse. And will make the specialist sufficiently leveraged to be able to buy up all the assets. So
Risky asset, like a technology, so the amount on it, there can be net amount invested in it, or
no, it's
also
zero.
Does it? So every time, so the intermediaries are borrowing risk free.
Yes, and that's what Darrell's comment.
Yeah, that was their comment. I understand that, but now they're borrowing risk free. And what is the? And I can understand the
continuous time.
So that the continuous time says that you can always
Diffusion process, exactly. Yes. Very good. So when there is constraint, when the constraint binds, leverage goes up, risk premium goes up, but not through increasing prices, but collapsing risk-free rate, right? So basically the compensation of risky assets will be very large because the risk-free rate will be very low because the households are lending through the risk-free rate and not through the being equity partners in the hedge fund. So that's basically the logic, and that's it. So it is this. Well, there are a lot of interesting things are going on, but that's basically the main essence of the mechanism. So basically, this is what you will find, and I encourage you to see the similarities, right? So we see something very similar to effective risk aversion, but now it comes from a completely different reason. So basically, this is the wealth of specialists. It goes up when they have a lot of good shocks, randomly, good dividend shocks. When it goes up, we are in this unconstrained region. The specialists are happy to take, well, they don't have to take on that much risk themselves because there are a lot of equity investment is coming in from the households. And then, after a lot of bad shocks, the risk premium jumps up, and the way it jumps up is that the interest rate collapses. Okay? And in this case, there's a lot of leverage because specialists are in, they cannot take equity anymore because they don't have any skin in the game, so they have to borrow through the riskless rate. So their leverage is going up the roof.
So this leverage has no danger, right? Because of the continuous.
That's right. That's right. These guys don't go bankrupt. But still, their effective risk aversion is going up in the sense that the compensation has to be larger. So that's just another theory of the effective risk aversion. And this is what Chigo and his co-authors are using to motivate their empirical exercise. And you will see that once you go to empirics, there are some jumps in thought, but well, probably you will do better. So I think it's a very active and interesting area, and it's definitely not the last point on this. I mean, there are already other papers to this, but let me just tell you how it works. So the idea is that let's suppose that we are always in this constrained region. So the household the household contribution is proportional to the intermediary's wealth with this M. Now the difference will be for the empirical part, which is not in the theory, is that this constraint will fluctuate randomly. So sometimes you can give them more, sometimes you give them less, probably because their private benefit is changing, or probably because of something else. And then, so we rewrite this way. So basically, this is total wealth in the economy, and intermediate wealth is proportional to total wealth, and this proportionality is changing over time because of some reason which we don't know why. And then we go back to standard asset pricing. So the reason why I'm showing you to do full circle. So with CRRA utility, we saw this formula in the first slide. With CRRA utility, if intermediaries are holding all the assets, then basically this will be their consumption. So this psi will be some kind of proportionality coming from their utility function. So this is their consumption. So their marginal utility is this. So this is their pricing kernel in continuous time. And we also know that in continuous time, expected return follow. Well, there was a formula for that, which you can rewrite this way. Okay. So basically, what it says is that in this model, expected return of a given asset will be high because of two different reasons. One of them is that because, well, they will be low. So basically, let me do the other one. So a given asset will give you less compensation if its return is high when you are rich. That was the original argument. Or when everybody is rich. Or when the return is high when this proportionality, this constraint is less tight. So when you can give a lot of money to the intermediaries for some reason, because when this incentive problem is less tight, then if the returns of that particular asset are high exactly at that point, so these are covariance terms, then the expected return should be low. Okay, so that's kind of so that's the new addition. Okay, so this is market factor, and this is what they call intermediary capital factor. Okay, so there will be a two-factor model, and it turns out that you can test it if you find a good measure for that guy here. And they argue that the leverage will be a good factor because we did see that in the constrained region, the leverage of intermediaries was very high. So probably we can do the following proxy that just by definition, so just from here, this proportionality coefficient is intermediary wealth over all wealth. Now, if intermediaries wealth is broker-dealer's equity, and all wealth is all the assets in their balance sheet, which is the same as their equity plus debt, then you have a measure which measures this guy. That's kind of the argument. And then you take the covariance of this measure, innovations in this measure and returns, something very similar to what we did before with the liquidity factor. And you get this. Okay, so basically this shows, okay, so this is, they use broker-dealer leverage. And these are the periods when the leverage is changing. But this yellow one is the important one because these are the innovations. This is the unexpected changes. And then you make them covery with then you calculate the betas for every asset class. And this is a picture which corresponds to the first picture I showed you. Okay? I know I went a little bit fast. I can see that. But, you know, so think of this as advertising. So now you can sit down and read these papers. So let me just tell you what you see here. So the interesting thing about their paper is that they did it over many asset classes. So usually many asset pricing papers, empirical asset pricing, are concentrating only on stocks. Now, in principle, we should be able to price every asset out there, not only stocks. So this is what they try. So what you see here, these are commodities. So this com is commodities. It's a portfolio of commodities. These are exchanges, currencies. These are options. These are CDSs. And these FFs are Fama French factors, so they are stocks. So in principle, they try to price every asset. And you know, if you compare with the first picture, which I didn't copy here, it looks better, right? So it's not perfect, but it does look better. So these are this is their predicted excess return, and this is their real excess return, and it kind of lines up better. Yeah.
You have like 11 different, at least 11 different foreign exchange portfolios or assets. Those are different currencies. What are they?
How do you do the FX 1, 2, 3, 4?
Yeah.
I don't remember. Anybody know?
From a French, you all know how they do.
Yeah. So you know they have long descriptions of how they do each of these classes, and I'm pretty sure that.
And those are with the individual commodities, which is simply too many of them.
Yeah. I don't think they are individual. I think they are packages.
21?
Yeah, I don't know. We should check. So sometimes they are putting them in portfolios. How they do it, I don't know.
They're different. You could take the same commodity but different maturities.
Yes.
Different
Yes.
maturities,
Yes.
commodities.
Yes, there are thousands and thousands of assets, and yeah,
Okay.
we should read more carefully. So you know, Yes, so the reason why I wanted to put it here to see where this is going. And there are, so let me just point, so there are jumps here, right? So basically, so this WT is supposed to be proxying for all the assets in the economy under this thought experiment, which in this ratio we are measuring as basically one side of the balance sheet of the intermediaries. I mean, if you kind of look closely, this is the same WT which is here, which we measure as a market return. So, why they are not the same? They are not the same. So it's how to do this properly. It's a good question, and I don't think that anybody really knows the answer. But these are very interesting experiments, I would say. So and there are many others. So actually, yeah. So you should look around if you are interested in that. I can also give you some more references. Okay, so I guess it's time to conclude. So so we have only touched on the stream of papers on limits to arbitrage. So at least about that, there is this review article, which you can start if you want to. And then we went to capital constraints and asset pricing, which I didn't really give a good review. And we only touched on this. So there are many, many more papers. And itself is only a part of a large literature focusing on frictions in asset pricing. So you could kind of go in another direction, right? So what I showed you is a direction of capital limits and capital flows. You could go many other directions and come up with other type of ideas how to understand better what is going on in financial markets. So you could think about search frictions and networks. That's what Darrell told you about. You can think about intermediaries and macroeconomic fluctuations. That's what Yuli will talk about, which I think is all, both of them are very interesting. You can talk about speculation crashes and bubbles, which Jose will talk about, or asymmetric information and learning, which I think Ben will talk about. So all of these there are very different ways to. So basically, once you pick a friction, you can kind of follow that friction and try to figure out what does it does for the whole economy. And as we talked in the break with someone, I think it's a good approach for science, and this is in some sense what we are doing, is to zooming in and zooming out continuously. So sometimes you want to zoom in and understand the little bits of financial market frictions and how trading is done. And then you want to zoom out again and think about that, how this contributes to the whole economy. Take a step back. First, how it contributes to financial markets, and then probably to figure out why it's important for the whole economy itself. And I think there's a lot to understand. We are only at the beginning of this journey, even if it's going on for quite a time now. So hopefully many of you will join us and contribute in the decades to come. Thank you.